Okay, so I'm going to classify this training video as the master training video for key turns. I'm not going to talk about the DOP aspect of it because you can watch the other training videos for that. The reason why I want to classify it this way is because really when you boil it down, what we could do is we could almost ignore the other elements of this and just focus on what I'm going to talk about in this video. Because at the end of the day, each one of us, our objective is to make money in the market. And so because I've had a number of people use this for quite some time now, and obviously I've been using it for 15 years now, I've had quite a bit of experience in both my own trading and other traders that have been using this for some time to really help boil this down to what matters most in its application in the live market. And so I really just want to simplify this whole process for you so that there's not a lot of confusion. You know exactly what these three separate key turns prices mean, what they do, the purpose of them, why we would even use them. So the original key turns, when it was first built, just included the red and green lines. So I'll bring my crosshairs up here, these ones right here. And the basis of key turns is that we want to look at where is price in relation to this level. So if we think of key turns as like a tipping point, so this would be like the fulcrum of like a teeter-totter, something like that, where this lower price represents the exact tick where the bias turns from up to down. So obviously this lower price, the red one, would be, the bias would be down. So then the upper one, the green one, this dark green, would be up. Price has to move from one to the next in order to be up or down. So that's why there's two levels. Now, what I typically do is I don't, since they're one tick apart, I don't need to know what both of them are. So I just typically go for the lower one. And that's the one I'm focusing on because I know I want to be short below it and I want to be long above it. Okay. So the other element of the original key turns price is the language that I have used for a long time is, what's the call for the day? And all that means is that, is it up or down? The way that we know if it's down is if price is below this level. We know that it's up if price is above this level, and we know that because it's a tipping point. So then what we have what I like to refer to as overextension. And this just means that price has exceeded beyond this key turns level so much that we're overextended. There's going to be a point where there's a really good chance that we're probably going to gravitate towards the original key turns level. So now we get into these other two. Now, one of the things that you can do, so a couple of things about key turns, especially having three separate ones in your chart, and I'll talk about the other two in just a second here, is you can go up here to this little magnifying glass and it says show data box. And what this will do is it will open this up and you can actually see these values. So we can see that the red and green on this day was 32.97 and a quarter, obviously 0.5, the upper one, and then the yellow and blue. So this would be the second key turns. This is 32.98 and a quarter, and then obviously the higher tick would be 0.5, and then our third down here is 32.86 and 32.86.25. Okay, so sometimes what you'll have happen is you'll actually have one of these that is the exact same price as the other. So you're looking for it, like, where's the third key turns level? Well, it's probably the exact same tick value as one of the other prices. And so this is helpful to just get a quick view of that. So why the addition of two additional levels? Well, if we look at this day, we can see that, okay, well, we're overextended. What do I do? In a lot of videos I talk about breakouts. This is not a video about strategy. This video is about educating you on these key turns levels. What I wanted to do was have more opportunity to get into the market. And so what I did was I added 2 additional levels that enabled me to participate more in the market than just having one level up here. And so what we do with these other 2 levels is we actually treat them exactly the same as the original key turns level. Okay? So what does that mean? It means that we want to be long above them and we want to be short below them. And that really is it. So if we were to look at this day from the beginning, here's our opening candle, this red one here, we want to be long, so we try a buy, we're starting to break through, and so we reverse the position and go short. And then what we do is we look for breakout, or actually in this case breakdowns. We want to see prices breaking down below each of these bounces that were set, these lows here. And as price gravitates towards it, we want to be short. We know that there's a great chance, probability-wise, that the market will pause at these levels. So it's almost always safe to test it. So we're going to short that. We're going to do the same trade again. We can do it again. At some point, resistance / support becomes broken, and so we want to be aware of that. So when price can hold above this, we want to be long. So we can either just get long, we can, wait for something else to happen, either, higher high, higher low, etc. The bottom line to the additional key turns levels is to provide more opportunity. And when we're looking for opportunities, what we need as traders is we need something reliable, something that has high probability, something that's useful, that we can trade and actually make money from. So we have this low that was set here. We have a breakdown. So we have a nice trade here, and then we just immediately come back up through. So if we tried this short, we'd go long once it came up here, and then we have our original. So same exact play. We want to be short below it, long above it. Now, on this particular day, the second key turns level was not too far above that. And so in a situation like this, what I prefer to do is I like to look at this whole area that I want to be short. Just because it's so close, it's usually not large enough for me to feel like I need to just immediately get out once we break above here. Now we can run up, and that is totally fine. We'll just either get out, reverse position. If we're not in, we're just going to get long. But again, the bottom line to key turns is we want to be short below, long above, period, regardless of which one we're looking at. Okay? So as we come back down, so we're obviously going to be short. As we come down, what do we want to do? We want to be long. We want to get out of our short position and go long. Same thing here. And then we had a couple bounces from here that actually worked for about 2 points. And then now we want to be short. So we want to be short, and then we want to be long. So it's just this back and forth, and that's it. So what these additional levels did is they gave us a bunch of trades down here. If you traded it, then you did it extremely well, and it gave us an extra position up here. So this and this is this day. Every day is going to be a little bit different, but on this particular day, it provided us a little bit more of a buffer for our short positions, which was really nice. So that's how that works. And so every day is going to be different in the sense of where these prices are at, and it's just based on the algorithm that it uses to populate these numbers. Now, in regards to DOP, I mentioned I wasn't going to talk about it, but I do need to mention that DOP is specifically strictly off using this one, the green and red. And of course, you can change these colors if you want. So then we go to the next day. And what do? We want to be short below, long above, so we short that, goes to the tick, and it worked out really nice. And I mean, we could literally pick any day, we could pick any market, it's the same thing. So we're going to be short, okay, now we're going to be long, but we have, this was the day where they were really close all together. So we can short that, but obviously, we want to be long above it. We can short that, long above, same thing. So now we're buying. So in this type of situation, this is very similar to this, but since we had to push up here, we can buy and then buy again and then break even, get out, kind of whatever you want to do. This is Globex, so we just want to look for strength. And so we had some beautiful, beautiful entries all through here. We have some nice breakouts, and we just run. Next day opens, what do? We want to be long above, short below, so you could have got all that. In fact, almost every tick of that, because it gave you the exact prices. So anyways, I think you get the picture. The bottom line to key turns is that we want to be long above any one of these prices and short below any one of these prices. Why? The reason why is because, as you can see, the behavior of the market is that it will tend to gravitate in that direction. So as long as we're above these prices, we should flow, we should have great movement in that direction. Okay, now the other thing that I wanted to tell you about is something, markets that have astronomical movement, and that's typically, this is Bitcoin, this is BTC USD. You notice that each of these prices, you can't see three prices. You can't see three individual, and the reason why, if you look, they're actually all the same a lot of the days, not every day. And the reason for this is because there's so much movement. What these key turns prices do is they just kind of gravitate towards that, because it's so much, so big and so fast. They're kind of like opposite magnets. They just attract each other in that situation. That's the best way I can explain it. And so you're typically going to have, not much of a variance in price. There's nothing wrong with that. In fact, as you can see, so this particular day, the day I'm recording this, there's definitely more bias to buying, but we do have some attempts to the downside. This is a 5-minute chart. So we're not going to break this down, but you can easily see these days just took off from the line. We have overextension. We're trying to come back, and we take off again. And by the way, this is huge movement. So our key turns level is roughly 88.97, somewhere around there, and then we run up to 94.39, so like almost 600 points. So this is huge, and this is really effective to use if you trade this. I mean, you can just scroll through any of these days, just massive movements. What do we want to do here? Short below. We want to be long above. So we're shorting, we're selling breakdowns. It's just a repetitive process over and over and over again. Some really nice big runs. So it's an extremely useful tool. So let's look at another market. Okay, so this is the Euro USD. I just left it at a 5-minute chart. I mean, it doesn't really matter what chart you have. You just need to make sure you have 365 days loaded. So if you go to your data series, load data based on days, and then days to load 365. That's the only thing you need to make sure that you have set here. But we can see here, here's our original, and it looks like on this day, the second and third key turns levels were the same prices. So we really have two areas to look at. So obviously this worked really nice. Lots of great buying. Long above, short below. We have some attempts, but we have some nice runs here. And then we're dropping. We come down to these are the number 2 and 3. And then we're, long above, short below, long above, short below, long above. And then, we take off. Next day, bit of overextension, run down to the line. So we have some nice breakouts, breakdowns. Down through here, we make an attempt, come back through, long above. We can try all of these, but it's just the same exact thing. So long above, get out here, try short, and then we try long, and then we reverse that position, and we go short, we go long, and now we're short through all that. But so it doesn't really matter what we pull up. Bitcoin, Forex, futures, it really doesn't matter. It works the same way. And so what we do is we just keep it simple. We don't complicate things. We can just look at where is price in relation to these levels. Okay, and I'll just show you one more. Here's crude oil. So if you trade crude oil, beautiful, beautiful trades here. In fact, this is the day I'm recording. To the tick, exact price. This is why we use this. It's very, very effective. So we're going to be long. We're obviously short through all that. And so another comment I want to make is that we can short this as many times as we want. One of the things that you want to be careful of as a trader is that when you have a defined set strategy, and then you have a defined set of rules with that strategy, it's really important not to be in the live market and say, well, I'm not going to trade this one because we've already been there, and this is the one that's going to break through. Well, what you're doing is you're violating your rules. You're violating the framework for the strategy, and you need to be really careful with that. And so what's nice about this is that once we break through, we can go the opposite direction. So your losses can be really minimal. You can really minimize if you're trading the line, if you're trading the key turns level. Now, if you're trading breakdowns and breaks out, it's a little bit different because that's going to be more of how you navigate through each of those trades. But when you're trading the actual key turns prices, you don't really need to risk a lot because once we go the opposite direction, it's only a couple ticks away, and hitting that reverse button actually might not be so bad. But obviously you need to practice. It's kind of up to you and how you go about. But we're shorting this, we're buying all this, we can try another buy here. Okay, now we're breaking below. We may have gone long again, but now we're short and we get a bunch of that, and then we're coming again, we're testing this again. We only wicked through it, and then we got another rundown. So from Globex open until my time, not quite 4 o'clock in the morning. Yes, by now you know I am up all hours of the day. This, I mean, you could be done trading now and had a huge night. And that's what's great about these markets. In fact, any market is they're fluid. They constantly move. They're constantly moving. And what the key turns indicator does is it gives you an edge. You know exactly what to do and where to do it, and it shows you the exact price on that tipping point. Okay, and the very last thing I'll show you, because I know I will get questions about this, are stocks. You can use this on stocks. Here's Tesla, since that's been a popular one lately. Same exact rules apply, short below, long above, huge movement. We're long through all this, we're shorting some of that, long, short. I mean, you can do really, really well. So we were short almost from the open all day long, and then the next day we open all the way down here. So it really depends on how you go about this, but we would have been short at 571.6. Let's just round it to that. And then our next day opened down here that we want to be long above at 42. Let's just call it 43. So you're almost 30 points of movement, about 28 points of movement just over that 2-day period, plus whatever. That's just the range between those 2 days. And then the other thing, this is going to be, like I mentioned earlier with like Bitcoin, there's going to be a lot of days where all 3 key turns levels are the same. Doesn't matter. It's just the way that it worked out. And then you're going to have separation like on these days. When we just keep going back and just beautiful movement. We're buying all day long here. Then you have some days that are just kind of not moving much, but then we have a nice breakdown and you can get that. But it's the same story. Long above, short below. We're doing the same thing over and over and over again. So that is key turns. That's how we use it. We trade it the same way every single day, and we trade it the same way on every single market. And that's one of the reasons why this is probably, I would say, next to the box, one of the most popular indicators, because there's not a lot of thought that has to go into this. We just look at price, where is it at in relation to the key turns levels, plural, and then we can choose to get in or wait until it approaches the line, and there's so much you can do with it. And then once you get good, what you can do is you can track different markets. You can trade all of the E-minis, or if you trade the micros, and you can have 2 or 3 or 4 markets up at a time, and you can look at what each of them are doing and whatever types of trades that you're looking for. So what that means is just if you like to trade the line, or if you're looking for a breakout or a breakdown, usually at least 1, if not 2, and sometimes 3 or even 4 are going to have that happening all the time. So you could keep yourself pretty busy just navigating through all these different trades. But to keep it simple, just practice. And then once you get better and better and better at it, then you can just take things one step at a time. But that's how key turns works. And if you just keep it that simple, And I'm not saying to ignore the other videos, but if you just keep it that simple and just go through that process each day, then you'll be very happy with the results that you'll get.